Hello and welcome. And we had Q1 earnings, and diagnostic companies have especially reported very strong earnings, including the likes of a Metropolis. We're going to try to understand today as to what's playing out in this particular space by speaking with the management of Metropolis Health. But before that, as we always do, let's try and analyze the company a little better. Let's start with what Metropolis does, and it's India's second largest pathology chain. It started as one lab in a Mumbai garage and now has over 5,000 centers spread across 21 countries plus India. You've got Executive Chairperson Ameera Shah, who started this, and she's spent a better part of 25 years building this up. And of course, this was started by her father. Also, in terms of the current market cap, the size and the scale, 11,500 crore. Received PE investment in 2015, so the journey has been extremely interesting as I was reading through it. Now, the story itself, 1981, Dr. Sushil Shah opened a single path lab in Mumbai. He was operating out of his home. Ameera thereafter corporatized the entire chain and built scale to the business. Essentially, that was the formula. The insight that every city in any case has quality pathologists, but not necessarily good business builders, and that's what was capitalized on by Ameera as well as the company. Let's talk about the sauce, therefore. So the sauce is simple. The science stays with the doctor, and the doctor remains part of the pathology chain. But the scale, essentially, is what Metropolis drives. How do they drive the scale? Well, high-quality local path practices in a new city is what they identify. Thereafter, they buy a majority stake in it. The doctor partner stays, he retains a minority ownership. Metropolis, now this is what Metropolis adds. They add IT, operations, marketing, procurement and quality systems. All of this drives up the quantum of business that the path lab does, and it reduces the burden on the owner of the pathology lab. The partner, though, brings local trust, patient relationships and scientific expertise, all of which very necessary to scale a business like this. They started in South India, and thereafter they went all over India, and now they're global. 21 countries, and the international revenue is approximately 9% currently, growing, and 91% is the domestic revenue, therefore. The tests that they do, all of which will come up, and I'll speak about only a couple of them which are differentiated or interesting. Your routine tests, blood, urine, biochemistry and the like, of course. Semi-specialized tests, more complex panels requiring a little more sophistication in terms of analyzers. You've got specialty tests as well, high-end disease-focused diagnostics for specialists. Then there's True Health. Now, this is crucial. True Health is basically a bundled preventive package. This is not something which a patient who is not well comes in for a test for. This is a patient who's well, but is looking to ensure that his health metrics are in check in terms of the parameters. That's what he comes in for. What the beauty of this True Health is that if we can shift backwards, True Health essentially what it's for is the person who's looking to ensure that he is recurringly doing this test to ensure that all his health parameters are in check. That's essentially what True Health provides, and hence the recurring nature. Also, the ticket size is much higher. So if your regular customer pays around 700 to 800, in True Health, the customer pays 2,500, plus it's recurring in nature, and therefore it adds huge amounts of value with regard to Metropolis. Just something to keep in mind as we continue this discussion forward. Then there's oncology, which is cancer detection, women and child safety, which is fertility, pregnancy, hormonal, newborn testing and the like. There's chronic and infectious, which is long-term disease as well as infection monitoring tests. There's basic radiology, which is bones and the like. You've got hospital lab management. They run hospital labs under long-term agreements as well. Clinical trial tests, home collections, and of course international referring. All of that is what Metropolis does under one roof. Now, in terms of the domestic presence, let's try and spread it out. 50% of the revenue comes from the West. This is FY26 numbers, by the way, not too different otherwise as well. South is around 28, North is around 17, East is around 5. Tier 1 is around 66%, Tier 2 is 8%, so smaller. But Tier 3 is, again, 26%. And the growth in Tier 3 is extremely strong. Network, they've got around 212 labs currently across India. 5,000 touchpoints is what they have. Their collection centers. 750 towns is what they cover. 490 centers added in FY26 alone out of the 5,000 which they have today. And the center to lab ratio currently is 24:1. Very important to know this because it shows the efficiency. Actually, it's 1:24. I beg your pardon. So for every 24 centers, there's one lab. Sorry, 24:1 is the right way. But so 24:1, this basically signifies the efficiency that every lab creates for the number of centers they're able to create. This is, again, very important. As you scale, if you're able to improve this, automatically your EBITDA margins get better. Let's talk about the financials now. 13% is the 3-year revenue CAGR is what this business has clocked. We're neutral. You would expect this to be quicker, but 13% is what it's done. FY22 was obviously an inflated year. We've taken the last 3 years, and therefore the base year has a slight bit of a contraction in terms of revenue, something to mark out. Talk about EBITDA growth as well. 11% EBITDA growth is what the business has clocked, and net profit growth of around 10%. So that's on the P&L side of things. Let's talk about Q1 numbers. 17% growth. So that's a strong growth coming in Q1 itself versus the last 3 years. And even versus guidance, the EBITDA has grown at 23%. And what we've seen is margins get better. And net profit also has grown by 27%. So because the improvement in margins is getting captured in the net profit, as you can see. In terms of the margin trajectory, it's improved in Q1 FY27. But FY26 was also largely just about sub 25%. So broadly, it's on an improving trajectory, as you can see. 23% in FY25. So you're clearly seeing the improvement. It's expected to continue to improve in FY27. You're expected to see 100 bips of margin accretion, very likely, as per what management has guided. Let's talk about the balance sheet. 1,500 crore in terms of the balance sheet. It's 11,500 crore company, and therefore it's at approximately 7 to 8 times book is what this one trades at. When you look at the borrowing, nearly zero, so no concerns there. Cash and bank balance of around 60 crore is what this sits on, does around 65 crore of capex, FY27. That's the guidance. Cash flow. You've got largely stable cash flow, no concerns from a cash flow standpoint. Clear thumbs up, no worries at all. Talking about return ratios have been healthy. Comes off when margins come off, as you can see. But as margins get healthy, you start to see a pickup in terms of the return ratios, currently sitting at 18%. Anything above 15 is quite good for the Indian market. Let's look at shareholding pattern. You've got 49% promoter holding, which is strong. But below 50, that's one thing to keep in mind. But you look at FIs, 11%, DIs, 35%, and public 5%. It's essentially institutional heavy, and you can see that. And that's a positive. That gives you plenty of room to think about the fact that there are large institutions sitting in the company. Look at analyst recommendations. 19 buy calls, 2 holds, 2 sells. 15% upside is how analysts are rating this. This is average street analyst recommendations. Valuations. 42 times 1 year forward is what this trades at. The 5-year average has been 45 times, and the 5-year range has been 32 to 69 times. This was listed in 2019, and therefore we have the 5-year data, of course, with us. The guidance, revenue CAGR of 14 to 15% is what is expected for the next 3 years. That's the guidance. They've done 17 in Q1. Tier 3 is growing at 25%. So blockbuster in terms of the growth coming from Tier 3. I spoke about that. Patient volume at 9 to 10% growth expected. Margins expected to improve by 100 to 150 bips in FY27 versus the sub 25% in FY26. Specialty mix currently at 40. As it goes up towards 45, your margins will also improve. True Health is currently sub 20% of revenue, expected to be 25% in the next few years. I spoke about True Health. As True Health picks up, your margins will get better. Center to lab ratio in the medium term expected to be 1:30. In the slightly longer term, 1:35. We'll talk to management about this and what they're expecting. No price hikes undertaken since Jan 2025. Very keen to know as to what the price hike picture will look like going forward. We'll have Mr. C. Surendran, who is the Managing Director at Metropolis Health, on the other side. But we'll take a bit of a pause. Mr. Surendran, I'll take a bit of a breather, slip into a break, come back, speak with you. Thank you so much. Welcome back, and we're joined by Mr. Surendran. He's Managing Director at Metropolis Health. Mr. Surendran, great having you. Let me first start off with Q1. It's been much stronger than what you were penciling in You've guided for 14 to 15%. Normally, Q1 is a softer quarter as well, but you've done 17. Talk to us about what's driving the kind of traction you're seeing in the business.
Hi, good afternoon, Harsh, and good afternoon to all your viewers. You have already put all the numbers on the screen, so I will not, talk much about the numbers. Let me give you some details behind the numbers, right? See, quarter one was a very broad-based performance. If you look at it, both the revenues have gone up very well, and even the margins have gone better by about 210 bips. And also for us, both True Health and Specialty done well in the quarter. For us, the all the four regions that we operate with, north, south, west, east, all the four regions have done well. And also the tier two, tier three segment has really performed very well. And so it's a broad-based performance. That's the first thing that I would like to highlight here, right? And for us, the growth in quarter one was largely propelled by the patient volume growth. We could see almost a double-digit patient volume growth after a long time. Now, after the COVID, this first time that we hit a double-digit volume growth, and that's looking very healthy. So 10% growth has come on the back of the volume. And the True Health and specialty portfolio, the mix is getting better, and and hence it is delivering much better realization. So 7% growth has come from improvement realization. So that's a split of the 17% growth, Harsh.
Right. Two follow-ups, Mr. Surendran. One is if the growth is ahead of what you're penciling in, is that sustaining even in July and August, or was it a Q1 trend? So give us some color on whether these trends are actually sustaining in Q2 as well. And second, then why not hike your guidance? Why keep your guidance 14 to 15%? You've done very well in Q1.
Good. So, see, quarter one normally is a softer quarter, for the industry and for us also because we operate, the strongest markets at West and South, and, we're getting better in North. So, in these markets, normally quarter one is softer, but this time we had a much improved performance on the back of all the work that we've done in the past few quarters. So that's what the background that we already have it. And quarter two, let's see how it's pan out because normally quarter two is a good quarter for the industry because this is a time that you normally see after the monsoons, vector-borne disease, etc., coming in. But then that this sometime this whole climate cycle is getting a little erratic these days. So we really don't want to jump ahead of the curve. So and maintaining the similar levels of guidance at this point of time. As it progresses, we will see how much improvement that we can bring in. But overall, I think the progress is looking good.
Okay, okay. Yeah, point taken. Q1 is generally softer and therefore you're operating out of a softer base. I think that's the point you're trying to make. And therefore Q2 will obviously have a slightly higher base and may not benefit as much as Q1 has. Get your point. B2B versus B2C. Is there a thought process with regard to which one to calibrate? Is there a mix that you're looking to maintain internally? Any thoughts on that?
See, we have always driven B2C as a priority in the past, But last, couple of quarters, after we cleaned up our B2B base with a good quality B2B base, we started adding more on B2B clients as well. So today for us, both the engines are firing, B2B as well as B2C is firing. So we will focus on both the segments, and it's not one or the other. It's actually both in our case now. And there are certain markets we will really look at B2B as our growth engine. But there are many other stronger markets that we have where we look at B2C as a strong engine. So it's basically market specific. So few geographies we will go after B2C, few geographies we will go after B2B. But in any case, we are currently operating in 750 towns. So going deeper in all these towns and getting our, the center, the collection center network deeper is one exercise is a work in progress. So we keep adding around 250 to 300 collection centers in these 750 towns every quarter. That activity is getting more intense these days. And as we keep improving the number of centers in each of these 750 cities, now our B2C will start getting much better and deeper.
Sure. The addition guidance, I believe, is 400 to 500 centers annually. You've done 300 in Q1, if I've understood this right. So you front-loaded this a bit?
No, well, I think we have also, if you look at it, while we had added 300 centers in quarter one, we have also cleaned up some of the centers which are not productive or not compliant with our scheme of things and the processes. So there's a net addition wise, we have not done much number in quarter 1. So the 500, 600 number that we will add every year is actually a net number, including the cleanup that we will do. So in quarter 1, since we had the cleanup and the total additions have not really much, and hence in the remaining 500, 600 numbers has to come in the next 3 quarters, and that will be happening.
And if I were to get a sense of how margins evolve, at least Q1 margins, it seems, benefited from the patient volume that you got in Q1. Am I right in thinking that way? And the 100 to 150 bips EBITDA margin increase versus FY26, does that stay on track? Does anything change for you?
No, I mean, that's on track. Largely, like you rightly said, the operating leverage, definitely we get it. More patient volume growth and more productivity from every center that we put up will definitely help us in terms of improving the margins. But over and above that, we have undertaken some structural cost initiative in the last 4, 5 quarters, and that has started paying off well for us. And as we go forward, the results of some of the initiatives that you have picked up in the past few quarters will be start getting the benefit into the P&L. So hence we are pretty confident about the number that we are talking about on our guidance with respect to margin.
You've not done a price increase for what, 18 months now? Maybe more than 18 months now.
Yeah.
Price increase on the annual, does that only add to the possibility of margin increase? And when does that happen?
So normally we have done in the last 3 years, we have done price increase every year. January every year we used to do a price increase. But this year, for example, that there are GST benefits, some part of the material cost benefits that we got in from the GST changes that has been done by the government, and hence we decided to pass on those benefits to the consumer. That's the reason we are not taking a price increase next year. I mean, anyway, the next year is 6, 7 months away from now. We will look at all the scenarios at this point of time, and if there's the need, we will definitely look at a price increase maybe early next year.
Plenty to talk about, Mr. Surendran, but I'm going to have to unfortunately still take one more mandatory commercial. I'm going to dip into that, but plenty to talk about because the margin guidance, which you're currently sub 25%, it's expected to go to 27, 28%. What are the levers there? We've spoken about a couple of them, but what are the others? We'll talk a little bit about that and more. They're heading into insurance, True Health. There's plenty to talk about. Stay with us. On the other side, we'll quiz Mr. Surendran. Welcome back, and we're in conversation with Mr. Surendran of Metropolis Health. Mr. Surendran, first off, thank you so much for staying with us. Let me quickly ask you with regard to what margin levers you have, because this aspirational margin of getting to 27 to 28%, one, how quickly can you get there? And two, what are the levers you'll use?
So if you look at it last year, we ended with 24.5% kind of an EBITDA margin, and we said this year we will move up by 125 to 150 bips, and we are on course to do that. And then maybe in one more year from there, and we will move in towards that 27, 28%. That's largely the trajectory that you will see. Now, which all are the levers that are available with us? One, of course, the operating leverage is coming, and if you grow the revenues at 14, 15% coming on the back of patient volume growth, and I think that itself will provide some level of opportunity there. And the second one, like I mentioned some time back, some structural cost corrections have been initiated about 4 to 5 quarters back, and most of them are maturing now, and some of them are to do with our laboratory platform standardization and vendor consolidation, etc. So those benefits have already started coming in from quarter 1. Maybe we will complete this exercise in the next couple of quarters, so the full benefit will start flowing in. And the third one, of course, is on the productivity improvement of the existing centers and the labs that we have. And a lot of initiatives have been taken to improve the productivity from each of the labs and centers that we have across the country. And lastly, and much of the processes in the company are now getting automated, and manual efforts are being replaced by technology efforts, etc. So that's going to get us leverage. That could be a little more longer journey. So maybe in another 3, 4 quarters from now, most of the processes that we're getting automated and digitized will start helping in terms of improving our overall cost line. So these are some of the broader perspective, Harsh, if I can share with you.
Right. And Mr. Surendran, does True Health contribute meaningfully to the margin increase? Also, 25% of revenue is a tall ask, right? Even for True Health. But one, what is the timeline that you have in mind to realistically get there? And point number two, is it largely a tier 1 or a metro kind of a product, or is there enough traction in tier 2, tier 3 as well for True Health?
Right. So True Health is nothing but bundled products and largely wellness packages, etc. Right. And currently the traction is largely happening in the tier 1 cities and a bit in tier 2 cities. But as we see, the awareness is getting increased and more people are wanting to come and their preventive health checkups, etc. So hence we have started getting traction from tier 3 towns as well. We will start accelerating this in tier 3 as we go forward, and we'll definitely start getting much better, contribution from the tier 2, tier 3 towns as well. So if you look at the margin profile of True Health, it's slightly above the overall company level margins because you do multiple tests in one sample. So the logistic cost and the production cost or the testing cost, etc., will be little lesser and or maybe shared for many of the tests together. So that's why the True Health has slightly higher margins than the company levels of margins. And currently the contribution is about close to 20%, and we definitely want to take this up by for another 4-5% in the next couple of years.
What's the threat like from online and deep discount sort of players? Is there a large threat for you from those? And could that at all at some point of time be disruptive to margins, even if temporarily?
See, the competition was always there. There was never a day when you didn't have a competition, but the competitors have kept changing. Some of them are, the lab chains as we have in some of the towns. And then, of course, in between the health tech players is coming in. And then there are always these smaller labs in each of the towns and cities, so the competition continued to be there. I would not rate any one of them as a threat per se. Everyone has got a play available in the overall scheme of things. We have to find your own specialized area and keep growing that, either in terms of geography or in terms of skill set. But if you look at Metropolis is a 40-year-old brand, and it's been very much endorsed by the doctors. And on the illness segment, we are a very, very key player. And there are endorsements from many of the doctors across the country, particularly the specialty doctors, the clinicians who does all the high-end and specialized, diagnosis, etc. And we are partnering with them. So we have our space, and we have some of the geography we are very strong, and we have some of the geography we are getting into and becoming stronger. So our strategy and overall scheme of things will stay us very, very much ahead of the overall industry.
Mr. Surendran, acquisitions, what's the strategy and how many are you targeting, at least this year?
See, if you've seen in the last 3-4 quarters, we have done 4 acquisitions, and all the acquisition that we have done is largely, integrated, and maybe on the core diagnostics in the last leg of, integration, which should be over maybe in this quarter. And we are always in the hunt for looking at good targets of acquisitions. And our strategy for acquisition basically two big headers. One is in terms of geography. We want to go further in north or part of the geography, and hence we are north and east basically. And these two geographies, if we get good quality B2C targets available, we'll definitely evaluate it and look for it. And second, strategy is about, the skill set, test which we don't do, or niche test which is available in the industry, somebody developing. We will keep looking at adding skill set through their acquisitions. So these are the two basically this big strategies on acquisition. We are on the hunt, and we have a currently pipe available, and the due diligence are underway. And once everything comes online, then maybe we will be able to conclude some of them. But definitely, I can't tell you the timelines, but we are definitely wanting to have the acquisition speeded up.
All right, that gives us the sum and substance. Thank you so much, Mr. Surendran, for coming in and speaking to us. Of course, the other big lever is GLP-1 and the tests that requires, and I believe Metropolis will benefit from that as well. But completely timed out on this edition of All About Your Company. Thank you so much for tuning in from myself and everyone who puts this show together.